Welcome to episode number 9, Going Public. This is Value Investor TV podcast that helps you grow your wealth and become financially independent. My name is Beko, and this is Hari. Welcome, everybody. In this episode, we're going to talk about what is going private. You know, we hear this word IPO. Going public, not private. That would be the other way.
Wrong direction.
All the way around, yes. You hear IPO, going IPO, or going listed, becoming listed a lot in the newspaper. We'll talk about what does that mean, really. We'll talk about that. Before we do, let's just do a really quick recap like we always do. In the previous 2 episodes, we talked about market analysis, growth industry, steady industry, and declining industry. We also talked about the life cycle of business, how just like any organism, we compared it to living organisms. They come to this earth, and then they grow up, and then they plateau, and then they die. Similar to living organisms, organizations, companies go through a similar life cycle, and we talked about that in the previous episode. All right, and then also, we talked about company structure. We talked about board of directors, what they mean for us as investors. We talked about the difference between directors versus officers. Key things that we have to have in mind as an investor. So, Hari, let's today talk about going public, not private, going public.
Public, yeah.
Very important.
Different strokes.
So, IPO is another synonym for going public. They're interchangeable. So let's talk about IPO. Take us through what they mean. IPO.
Yeah, so the IPO actually stands for Initial Public Offering.
Yeah.
And so what this is that a company that is previously private. So if we're thinking about our hot dog stand, we are going and taking our company to the public markets. So now what that means is that we will talk to a company like Goldman Sachs or
Investment bank,
another type of investment bank. And what we'll do is we'll say we would like to sell our shares on the open market. And what that allows us to do is raise money. So, if you think back to our debt and equity discussion earlier, this is essentially selling equity on the private market or on the public market. So anybody can buy. And this is our first offering. So we are not making we can make subsequent offerings, but they're not called IPOs. Those can still be underwritten and all of that. So the public marketplace is, you've probably heard of the New York Stock Exchange or NASDAQ or, there are numerous other exchanges like that. But what it means is that anybody with a brokerage account that has and can access these, shares once they are on the market, and they can be traded Monday through Friday, from 8:30 to 3 o'clock Central Time.
Mm-hmm.
And what the offering is that essentially what it does is an underwriter will my hot dog company goes to the underwriting business and tells them I want to sell my company. They onto the public markets. What price do you think that we can get, for this? And they'll say, okay, I think we can sell it on the public market for $15. We will buy it from you, the company, for $12. And then we will try and sell as many of these shares that we've bought. So the underwriter is basically guaranteeing a certain price for the shares of the thing. So they're taking on some level of risk. And as they are taking on that risk, they also then... they have a network of clients, private individuals, institutional investors like banks and other banks. Sometimes these, and they'll sell those shares to those, even before the market opens. So they're basically offloading the cost. They buy it at $12, they sell it at $13 or $14, and then it goes public at $15. Now they may still retain some blocks of shares even after the offering occurs, and then they sell those later.
Yeah.
But what you want to see out of this is that the company gets some level of equity, and the or I'm sorry, the company sells equity, gets some money, and they often have a reason for doing it. What some of the reasons are that they want to raise money to go buy another company, to extinguish debt, and they'll talk about that as part of that IPO process.
Right. So really quick. So initial public offering, you're offering your ownership stake in the public marketplace so that anyone with trading account can buy into the company.
Right.
And the process the process of going public is facilitated by investment banks, the likes of Goldman Sachs, Morgan Stanley, et cetera, et cetera.
Correct.
And what they do is, in this process of going public, they will underwrite the share offerings.
Yeah.
And so that's the process. That's the process in large, broad strokes. A company wants to raise money in the public marketplace. They approach investment bank, and investment bank in return goes to their clients and say, "Hey, look, this company right there, they're about to go public. Why don't you buy some shares of this company? They're going to go big."
And the part of that is also the investment bank will really try and sell this company, right? And so part of this whole process is, before the IPO even happens, the company will do what's called a roadshow. So they'll travel the world, the U.S., and talk to a bunch of institutional investors saying, "Hey, and we're about to IPO. You should buy these shares. This is why we think this thing will be worth a lot more than what you pay for it." And a lot of times the IPO prices will be, it could skyrocket in the first day. But the thing is that the idea is that they're trying to get rid of these shares, raise that money, do something with it. And so they are incentivized to tell you how great this thing is. But on the flip side, they're also incentivized to have, the highest price that they can get when they sell their shares, right? So they're never going to sell shares at if they can get it for $50 a share, they're going to sell it.
They will,
at that.
yeah.
And if it can be 100, even better.
Sure.
Right. So from the bank's perspective, they're going to try and sell it at a high price, and their incentive is to get as much money as possible, for the thing. So that means that a lot of times the value of the underlying security, of the company, doesn't necessarily reflect, the price that's being paid there.
Exactly.
So, one of the dangers, of the IPO process. So, we'll talk a little bit more about that, as we go, through this. But I think this is, this kind of idea is that the goal for the underwriter and for the company is sell it at as a high price as possible.
Yeah. So that's so important for us to recognize, because as investors, it's very tempting when a company goes, okay, $10, and the next day, as soon as it IPOs, it just doubles.
Yeah.
It's a quick money, and you can think, oh wow, I could have benefited so much from buying into IPO.
Right.
But really, you got to think about the incentive alignment that is in place. It's a structural incentive alignments that isn't really for retail investors.
Right.
And so investment bank, when I think of investment banks, and I have a lot of friends who work in them, it's really effectively salesmen.
Yeah.
What they're out to do is to sell on your behalf. Let's say our hot dog stand, we enlist Goldman Sachs as our investment bank. What they will do is, instead of us going out and doing the roadshow, they will go out to a roadshow and do selling on our behalf. Selling the equity shares on our behalf, or debt, or whatever it may be.
Yeah, and this is the idea here is also that like a company like Goldman Sachs offers a suite of services to companies, right? That may be to help them find a buyer. It may be to do this IPO. So they have a incentive to not really tell you the whole story, right? Because they want to be on the good side of the company, right? And I'm not saying that they're doing it, because they're bad people, right? But they have a bias inherent that if I'm trying to sell services later after I IPO this company, like let's say somebody comes and acquires the company too, they would want to have good relationships so that when the company says, hey, somebody's come and offered a buyout price, I'm going to go talk to this company that I have a good relationship with.
Exactly.
So you have to be kind of wary of what their incentives are, right? We talked a lot about incentives when we talked about the board of directors and CEOs, and what is their alignment, right? So if their goal is to get the highest, obviously they're in the business of making money, right? They're like every company, they want to make a profit. If their incentives are to get as high a price as possible, then that means that you have to be more wary of what are they actually saying, right? And so, that goes into our, more about looking at the filings and things like that.
Yeah,
right?
which we will do in the next episode. So in the public marketplace, obviously in the U.S., the big ones are NASDAQ, New York Stock Exchange. You've all heard of them probably being talked about in newspapers and whatnot. And there are other exchanges elsewhere across the world.
Yep.
Every country has one or two. Canada, Toronto Stock Exchange. You have in the UK, London, China, the Shanghai, Korea Stock Exchange, Japan Stock Exchange. Every country has one.
Right.
So companies that are that are from those respective countries most likely will raise capital in these marketplaces through a process known as the IPO.
And it's sometimes you'll be surprised that some companies that are based in other countries want to be listed in the U.S. from a prestige factor and other things. So you may actually get companies that are based in China that operate in the Chinese market, but have dual listings in the U.S. as well as the Shanghai Stock Exchange. So
yeah, we'll talk about those in the later episodes. Okay, so let's look. So when a company goes public, from private company to public company, you can't just say, oh, our hot dog stands. Let's say, imagine our hot dog stand. Let's say we're going public. You can't just sell our shares in the public marketplace without any kind of regulation or scrutiny, because what public market effectively does to the company, let's say our hot dog stand, is it brings in a lot of scrutiny. And so let's talk about that. What is, public offering requires a lot of regulatory things. You got to comply with a whole bunch of stuff. In the U.S., it's SEC that regulates that. What is required in going public, and why is it so important?
Yeah. So, I think a lot of this actually goes all the way back to the Great Depression and, the 1920s. So prior to the 1934 Securities and Exchange Act, it was kind of the Wild West. You could basically go and say, hey, guys, I've built a time machine. And this is the greatest thing ever. You should invest in my company, right? And so, what it really gets down to is no one was actually, verifying your financials, so auditing your financials and verifying that what you're saying and telling investors is actually true. So, if you say something that, and the way that the SEC kind of couches all of these things are, and there's a lot of legal terms here, but really it's about are you saying something and for example, Elon Musk right now is is under investigation for essentially saying my company is going to be bought out. I've secured the funding for that
for 20
at a price that was significantly higher than the current share price, right? And so if that is indeed true, then the SEC is fine with it, right? But if you are announcing this deal, right, you are announcing it before, and before anything has happened, you can manipulate the share price, right? So what the SEC really wants you to say in your thing is they're going to offer you, they're going to make you say, what does my business do? What are the risks associated with investing in my business? They're actually going to make you compare your returns, and in an IPO setting, you won't see this, but and so they're going to ask you to kind of give you an understanding of what are the board of directors, who runs this company, what are the financials for the last 2 or 3 years, and so on. So the idea here is to prevent any sort of fraud, right?
Mm-hmm.
And so to give you an example, the SEC even investigates companies even before they actually get listed on in the public markets. So Theranos is actually an example of that. They were under investigation because they were, essentially saying that we have this product that they don't have, and they were actually lying to investors, and that becomes a criminal thing. And Enron actually fell under a lot of SEC rules violations and so on. But in addition to that, so you have to go under a lot of scrutiny. You're going to have people reviewing your documents, making sure that what you're saying is true. And on top of that, you have to go through an audit, right? And so the audit is essentially you get one of these CPA firms, they call them the Big Four, and then there are smaller ones that do this also. But what they essentially do is they say, okay, I'm going to look at the financial statements that you provide in your IPO, and then I'm going to ask you to give me the receipts. I'm going to actually look at your bank statements. I'm going to look at everything, and they can scrutinize, to a very low level, and then they have to, sign off, right? So to give you an idea of how that was, it was, Arthur Andersen was the auditor for Enron. Enron basically said, just made up all their financial statements. Arthur Andersen just said, okay, sounds good to me, and signed off on it. Arthur Andersen doesn't, exist anymore, right? I mean, they were basically sued out of existence. So, the fraud part of this is, there's auditing, and that's not to say that you can still get stuff past the auditor, right? And we'll actually probably talk about this in a much later episode, about how companies can do some shenanigans with their finances to kind of sneak by the what's stuff behind the auditor. And then what, in addition to this, now you are now required to, when you produce public relations, PR, send wires out, of news stories and stuff like that. You have to be careful about what you say in those statements. And you can project like, hey, we think we're gonna grow this much, or we think, but you have to couch it and say, these are forward-looking statements. They may or may not happen. They carry risk, and these kind of things. Mm-hmm. And then, lastly, the company actually has to pay money to be listed, right? And not only are they, increasing their regulatory burden, but they're also actually paying, cash to be listed on the stock exchange. And what that cash does is it creates a marketplace for their shares. So there's a market maker who actually, manages the exchange, of those, of the shares between brokerage houses and stuff like that. So there's a fee that is paid, to do this. And then you have to have a investor relations department, right? And, the investor relations department can, be the one that handles incoming requests from, for annual reports, for answering questions. My interactions with investor relations departments goes from they don't do anything to all the way to, they tell you, happy to answer questions. And in some cases, we'll put you in touch with, I'll go ask the CFO and then come back and tell you. So,
yeah,
every company has to have, these kind of basic things in order to go public. So, those costs can vary, greatly depending on the size of the company, the complexity of the, audit process, and so on. So, you won't see very tiny companies listed here, largely because of that burden. And you won't see, but what happens is that most companies, after they get to a certain size, it's just better for them because they can't have too many investors. They have to be publicly traded. Right. So that sometimes it just forces their hand, and they have to go to the public market.
Right. So you have all this requirements, regulatory requirements. You have to pay the marketplace to be listed. You have to have a fully functional investor relations department underneath your company to manage being public. You have all these requirements. So you like you said in the last statement right there, that when a company gets to a certain size, it's better for them to actually go public than private, even though you have all these requirements that is necessary to go public. Right. Why do companies go public then?
Well, I mean, you're weighing a lot of these things, right? You're saying I want to go public because I have investors already who we're unlikely to. So when we talked about debt versus equity earlier, right? You can go to your buddy, right, who can give you $1,000 or $2,000 to help you get your business started. But when you get to a certain size, it's a lot harder to raise money because you need tens of millions of dollars. You don't need $1,000, right? And so in order to get that kind of funding, you may have to diversify the number of people that give you that source of money. And so you go to the public markets, for that purpose. But a lot of the times, especially when you talk about venture capital backed companies, they want to have an exit, right? And so for them, an exit could be two things. It could be selling the company, or could be listing the company on the public market. Because once it's on the public market, they can dump their shares and then return that capital back to their limited partners. So it also becomes a lot easier to raise money. So we talked about the IPO, but you can also do secondary offerings, right? So after the company's already listed, you can say, we're going to sell 1 million more shares at some price. And they go back to the underwriter, and the underwriter does that so that they don't flood the market with an extra 1 million shares, and they sell it over time. And there's a whole art and science to all of that. The other thing is it allows for, the stock market is very good at giving you a quote for how much your company is worth. And so you can see on a daily basis what, the value of the entire business is. So there's a liquidity issue here too, that let's say I'm an insider who bought shares in this company, right? I have a lockout period of 6 months or a year or however long that is, where I can't sell my shares, and this prevents them from just dumping their shares immediately after the IPO. But after that, I can sell my shares, so I can I liquidate some of my holdings because I want to go buy a house or do whatever. So selling your the insiders who got equity very early on can sell their shares into the company.
Yeah.
Go ahead.
One of the things I wanted to mention was you can do all this in the private marketplace as well.
Right.
It's just that the liquidity aspect of it, I think, is very important to highlight.
Yeah.
We obviously work at a startup company. You see all these startup companies out from Silicon Valley, mostly from but across the world, where a startup gets started, gets born. You have investors funding the startup, and then as the startup matures, let's say an investor, he wants to exit out of the position. He wants to retrieve his cash from the company and sell his equity stake in the marketplace, be it public or private. Let's say in this case, this is private company. There may not necessarily be a buyer in the private marketplace.
Yeah.
Because the private marketplace, it's very exclusive. First of all, right? Only if you talk to VC firms, they'll only accept money from high net worth individuals most of the times.
Right.
And so it's very exclusive. And the marketplace itself is very small relative to the public marketplace. So if you want to sell a portion of equity stake in the company, there may not be a buyer out there. But in the public marketplace, that's much better. The liquidity aspect of it, I wanted to highlight.
Right. But I mean, that also goes back to the thing of, you have now more public scrutiny. In the case of some of these Silicon Valley companies, they don't actually have a business, right? And so what they do is they keep raising money until people realize that this thing is terrible, right? And then they dump it on the public market. And that's how they exit this thing. And so what they've done is essentially speculated on the value of the company. They've increased the earnings that they've increased the value of the company through these equity offerings that they've done. And then the value of the company increases over time. But at some point, what they say is nobody wants to put more money in because they're like, if this is a losing battle. And then they go to the IPO market. And so when they IPO, they're essentially using that as an exit. Yeah. And so you actually can see this in, a great example of this is Blue Apron. So June of 2017, Blue Apron IPO'd at around $10 a share, and it's trading at $1, 70 or so, 60 a share right now, today. And what it shows you is that this is a company that was never going to turn a profit. They had a business model that just doesn't work. And, despite that, there have been a lot of Me Too companies that have been doing exactly what Blue Apron has done. Blue Apron has, hemorrhaged cash. But if you ask these VC firms, what they'll tell you is it was a successful exit for us.
Oh, yeah.
Because what they did was they raised money at a very low valuation, kept raising it up through other fools investing into this company, and then they dump it on the public market. The public market buys and sells the shares, and then a year and a half later the company has basically lost 90% of its value.
Yeah, the winner in this whole game is Silicon Valley, the elite smart investors, the smart money, and then they just dump it in the public marketplace, and retail dumb money picks it up and has to hold that junk.
Well, the funny thing is the retail investor here is actually the smartest guy in the room, because they realize that there is no value in this company, and that's why it's trading at $1, $1.50 a share or so. What I would say is that you can fool some of the people all of the time, and all of the people some of the time, but you can't fool all of the people all of the time, right? And that's essentially what has happened here. Is when you look at some of these companies, and you look at the IPOs, you see they say, oh, there's a lot of promise with this business, and Blue Apron had a lot of those, promising things. But essentially what happens is there is no business underlying the stock, right? And that's the difference that we're trying to highlight here. Is there's a fundamental nature that you have to understand. If you understand this is a good business, then there is value in the company. And if there's value in the company, then you can assess that value and assign a price. And if the price is that you're willing to pay is, or the market is willing to pay is a lot lower than the value, then you may have a deal here, right? And so part of this is learning about IPOs is seeing they are not incentivized to give you a deal, right? If they were giving you a deal, they would be losing money, right? And so what you have to start looking at is, now that, Blue Apron has lost 90% of its value, is it cheap enough, right? And so, that's a discussion for a later date, but value is such an important part of this concept. And, looking at the IPO, it may be difficult to assess based on what information they're providing, because they have a slant to it.
Exactly. All right, we covered a lot of topic today on this episode, going public. We talked about what is IPO. We talked about going public, all the exchanges that are out there in the U.S., the famous one, NASDAQ, New York Stock Exchange. And we talked about the requirements, the prerequisites of going public. What does it take? It takes a lot of scrutiny. Financial scrutiny. Actually, you need to pay up these exchanges, so that there's actually actual cost to the companies when you want to list. But despite the burden, a lot of people decide to go public because of many benefits, namely liquidity, easier to raise cash, and some more. And so that is it for us today, going public. Thank you all for listening. And again, if you liked the episode, please go ahead and subscribe to our channel. We'd be happy to have you as our subscribers. We're growing, and so if you could subscribe, that would help us a lot.
And click the bell for notifications.
And also, if you want to leave us comments, we'd be happy to chat with you there. All right, see you on the next episode. Thank you.
All right, thanks.